You know, when we look back at '08, you had very little exposure to Lehman throughout the industry. But when Reserve Fund broke that dollar, broke the buck, you had a massive run on prime money market funds, and it really took some extraordinary steps by the government to put a halt to that run. And I think we've got some questions here whether the events in '08 prove that the structure of money market funds makes the industry today susceptible to that kind of a run. That's up for interpretation. What isn't subject to interpretation, though, is that we're now left with an industry that is at least implicitly government-backed. And given recent headlines noting the potential exposure of a European bank debt crisis, there are the questions that are going to have to be kicked around in this committee. You know, we're going to have to ask, has the industry fundamentally changed since then? Is it in a better position to prevent an industry-wide run this time? Will the government be forced to intervene again in such a circumstance? But I hope that the hearing not only answers those questions. At the end of the day, I think we've got to remove the perception that money market funds are risk-free or government-backed, and I think reducing investors' incentives to redeem shares from distressed funds is going to result in more stable funds and a more stable financial system. How that's achieved is the subject of this hearing. We've got various competing ideas here that are going to be presented to us in terms of the best way forward. But I thank the Chairman for holding this timely hearing. I think that these are subjects that need to be resolved, and I appreciate his leadership in trying to kick this off. Thank you.